Okay, hello, welcome everyone. This is our first ever video cast, which we're really pleased to be presenting today. This week, Integritas Wealth Partners have been hosting our first ever webinars in the current environment we're in while we're all remote working. And so for those people who were not able to attend, we thought it'd be useful for the three of us, myself, Paul Alker, and Sean McCrum, to just run over some of the more pertinent points that we thought from the webinars, just to give a little brief overview of what we were discussing. And we'll try and produce a few more video casts going forward, try and keep them informative, educational, and sometimes entertaining. What we're going to do is just going to run through a few of the slides that we discussed in the webinars, which are titled Perspective Markets and Looking Beyond COVID-19, and a brief conversation between the three of us, just so we can discuss what was talked about and really just give a flavour of what our webinars will look like going forward. So first of all, this is a slide I chose to talk about. Really, it's looking at recessions, as we are now in a recession. It's quite clear, and really putting that into context of where it is in the grand scheme of things. This graph here looks at the cumulative effect of expansions and recessions, and what's clear to see, I suppose, is that expansions are far larger with far bigger impacts than recessions, no matter how painful recessions may feel at the time, and this one certainly being no different. Now, the context of this slide is really about not to believe predictions. What we're hearing right now is a lot of noise about, is it V-shaped, U-shaped, W-shaped, L-shaped, or even hockey stick shaped. And if we look back at back in time, this is 70 years worth. Now, all of these recessions and expansions and recoveries took different shapes, but right now it doesn't matter too much. The fact is that there was a recovery, there will be a recovery again, and that's the bigger picture of how we're looking at things. The other thing I thought really is that an important point as we are in this recession, have entered this recession, is that the numbers we are seeing that are making all the headline noises actually aren't that staggering in themselves, and we have been there before. What is staggering and what is different is the pace of change as we entered into this recession, and that's really because we are in a self-induced recession, almost like a self-induced coma of the economy, as the decision to close down huge parts of the economy was taken by governments in order to prevent further loss of life, and obviously an understandable decision and a very complicated and tough decision for governments to make. And so the huge numbers of unemployed that have happened extremely quickly, could equally come back with the economy being opened up again as we see restrictions being lifted, especially as a lot of the job losses are in the sort of casual working areas such as bars, restaurants, shops. As they open, there could be, I suppose, quite a quick recovery in terms of employment, but that shape will probably depend on, the shape of the recovery will depend on the loosening of restrictions. And then finally, the other point that I was coming to, I suppose, is more about what we do for clients, which is investing their money, investing their wealth, helping them achieve their longer term goals. And so what we've seen is the stock market reacts a lot quicker than the details we get on GDP growth, the details we get on moving to recession. And by the time we know we're in a recession, the stock markets are already there. The stock markets are built around forecasting future expectations of growth. And so what we see is that the stock market moves first. The GDP is a lagging indicator of that. And so what we're talking to clients about, if you're not feeling comfortable right now, rather than us shying away from having that conversation, if you were to wait for news to be better, restrictions to be lifted, and an economic recovery to be visible, the stock markets would already be really much higher. So we're not certainly shying away from the conversations we're having with clients. And that was my real take on this slide. I don't know if anyone's got anything to add to that, Paul or Sean.
Thanks, Ed. just it's a great slide, that, and I think the chart is fantastic, because what you can see is the time frame that we're looking at, and I think it's almost like the headlines and these predictions dominate much more than the sort of the blue areas dominate, if you see what I mean. So from a noise point of view, those little sort of red sections get more press than the actual blue sections. So I think the key thing is don't believe predictions. I think fundamentals you've got to be confident with, really.
Yeah, it's difficult, isn't it? So you're sat there watching the news, be it Sky News, Bloomberg, or BBC News. There's always an expert telling you what's going to happen with the economy or with markets and all these things, and they tend to be talking about very different things. So they have different views on when it's going to get back to normal, what's going to be the thing that's going to resolve it. But I think the tricky bit is sitting there and consuming that. So you're sitting watching the news, you read a paper, it's a very different opinion from one to another. But if people are comfortable with a long-term view, a lot of that is just background noise. As you said, with that chart that really highlights very nicely, when it picks up, it's a nice favourable position. When those dips that do unfortunately happen, the news is all very much on them and wanting to create a story and make a big thing about it. So I think the slide itself, don't believe predictions, it sums it up really nicely, because there's so many different people with so many different opinions on what's going to happen or what's not going to happen.
Yeah, and if longer term, if we believe in capitalism, if we believe that there will be a recovery, then we've got to use our fundamentals and look longer term for investors and take opportunities when they come. Okay, moving on then onto our next slide. Paul, this is one that you've decided to talk about, and a fascinating slide that it is.
Yes, this slide I first saw this slide from one of Dan's presentations earlier this year, and it knocked my socks off, because it's just, when you look at the land mass, but compare that small area of the globe, that basically more people are living within that circle, and actually it doesn't even include parts of Russia and Pakistan. It's the areas in the dark grey, contain more people than actually outside in the rest of the world. And not only that, in another slide that Dan had produced, the demographics within this region are so geared to the markets because of the younger population, people who are prepared to spend. So there are companies that our clients will, indirectly be investing into through their portfolios. Good example will be, say, Unilever, who will be supplying these sort of the growing population, more affluent population, with consumer staples, the shopping trolley stocks, and I think that just looking at the opportunities that this particular region, as well as investing in emerging markets, but also investing in those companies that are supplying the emerging markets, it's a great opportunity. And I think that if anyone's concerned about where the world is going, I think they just have to look at what's happening in China and India. China probably more so, with regards to developments and spending habits.
Yeah, absolutely. And just looking at this slide, as you say, I think we often get quite blinkered by what's in the news, what's closest to us, and actually there's a great big world out there which we've spent a lot of time over the last year prior to COVID talking about Brexit. Now, in terms of the global economy, I'm sure all these the growth of the middle classes in Southeast Asia, they're not concerned particularly about Brexit. China, now the second largest economy in the world, Brexit wasn't high up on the agenda of companies there when they're making investment decisions. Might have been on the agenda, but certainly wasn't as high as it has been in all the conversations we've been having with clients, with investment managers, among conversations generally everywhere you go. And this just really highlights how blinkered we can be. So any other thoughts on this?
So for me, I mean, it's a great slide, right? It shows us the opportunity in those regions, and you've only got to look at some of the companies that really benefit from that opportunity. So Paul mentioned Unilever, but BMW, it's their largest market. China, they sell twice as many cars in China as they do in Germany, and everyone in Germany drives a BMW or a Mercedes. Their taxis are BMWs. There's no Toyota Prius taxis in Germany. Yet China, it's a huge market for BMW, and also starting to become a huge market for your luxury goods like your Rolls Royces and all those things. So if we think of the shift towards the economy there, some of the infrastructure investment around the Belt and Road program, there's some really interesting investment themes that can really capture what's happening on that slide.
Yeah, absolutely. Okay, great. Sean, over to your slide for discussion.
Thank you, Ed. So this is quite a busy slide. There's lots going on in this slide, but really interesting. So what it does is it shows us an investment journey from 1987 to current times. So what you can clearly see there is someone was to have invested 100,000 in the blue line, which is the FTSE All Share. That £100,000 today would be worth 1.695 million. The same £100,000 invested in cash would be worth 466,000. But it tells us a little bit more than that. So obviously we've got the equity, which is the blue line. We have commercial property, which is the red line. And we've got bonds, cash, and inflation as well. But the good bits to note here is what's happened in between that journey. So you can clearly see that in that period of time, there's been some significant market events. So market events aren't new. So obviously we're seeing what we're seeing now with COVID-19. It's happened before, and the one that's kind of quite notable there is 9/11. So 9/11, we all knew what happened to markets after that period. Then we had the invasion of Iraq. Markets continued to take a bit of a dip, and equities then dipped accordingly. We then look at the next market event, which is after a significant period of markets picking up and rising and all being well in the world, was the credit crisis in 2008. So the credit crisis in 2008, we saw a fall of the FTSE All Share of 30%. So it dropped in 1 year, and you can see that drop there, and property dropped in the same way as did equities. But then it recovered the following year. So the following year, we saw that 30% pick up again. So markets were back to normal, but they were rising, and we've seen since that period markets continuing to rise. And there's been a few dips and a few bumps in the road. So we've seen the recent trade tensions causing some of those dips. The bit that's obviously uncertain on here is the 2020 figures. So the 2020 figures will undoubtedly show a drop from COVID-19. But what this shows us for me, and I think the key reason for chatting it through, is investing in equities and real assets, very much a long-term sport, but it's the only way to keep pace and to outperform inflation. So if you look at cash returns now, those are being eroded by inflation. It's when we look back to the good cash returns that we saw in 2007 of 5.5%, 6%, those are no longer there. Inflation's low, granted, but it was only in 1990 that inflation was up at 9.5%. And if you listen to a lot of predictions, as we said earlier, don't necessarily listen to predictions, but a lot of the predictions now are inflation is going to start picking up again. So for me, and I think the summary here is, this is a really good example of why we invest for the long term. And we can see it's not a straight line, it's not a particularly smooth journey, but actually investing is the way to make sure your assets over the long term are exceeding inflation and achieving the goals that you want them to achieve.
Yeah, and it's about having appropriate portfolios for investors as well, isn't it? Because time frame is the big thing here, really. If you're investing for next year, you're not going to want to be in an equity portfolio. These are the conversations we have with our clients quite frequently, and part of that onboarding, part of that finding out the appetite for risk and suitability of portfolios is explaining that this happens throughout time, that markets can fall 30 to 50%, and we've seen it in the past, and we'll see it again. So that's part of the conversation we have. And so if you can't stomach that or don't have the time frame to accept that volatility, then we've got to look at other ways to invest your money, and it's not going to be an equity portfolio. Now, I think looking at this, you can see all the events that happened in all those times. I mean, the financial crisis, firmly in my memory, as I started as a portfolio manager in 2007, my first few years were really just dealing with the global financial crisis. And, we know what it's like, remember what it felt like. And that really helps when going through these situations, remembering what it feels like. But those clients who maintained investment or used the opportunity of investing through a bear market, sticking to their plan, have seen fantastic returns since. And it's having that memory, having that knowledge to go on that path with clients. And when it feels hardest, that's quite often a really, that's when you've got to hold your own and stick to your guns, stick to your plan. It felt so tough in those times in 2008-9. It's feeling tough right now for investors. Certainly towards the end of March felt horrific, but we've been there before, and we believe that markets will recover.
Thanks, Ed. Yeah, I think this is an excellent slide, this, because, well, it's a bit of a coincidence, but it also coincides with my career. So I'm probably giving away my age a little bit, but I very much, I still remember Black Monday, the headlines, the world was about to end, what was going on with the stock market. Although I was probably not as involved at that stage as a whippersnapper. I had a lot of other things on my mind probably at that stage. But basically, yeah, just to I could speak all day long. I'm not going to, so I promise. But basically, there are a couple of things here that I'd like to just reiterate. And also maybe, and again, we're not going to look at predictions, but I'll be interested to see what happens with that red line, because obviously, typically people look at bricks and mortar or property as a very, very secure investment. And it isn't, because you can see in 2007, obviously, commercial property, this is obviously UK, did take a hit. And I'm wondering, with all this remote working and a number of sort of bricks and mortar businesses struggling, what's going to happen with the commercial property sector. But I think as long as our clients are investing in a very diversified portfolio, yes, this is the FTSE All Share. But the story, in fact, the S&P, I think Dan mentioned, was actually a much greater outperformance than the FTSE All Share. So one would be, if you were invested in primarily in US equities, you'd have done a lot better. So I would say a couple of key messages. Yes, there are going to be downturns, as Sean has mentioned, Ed has mentioned. And I saw a very interesting chart the other day. And again, these charts keep coming out now, obviously, because people are sort of saying, well, what's happened in the last 10, 20, 30 years when we have had a downturn? And let's look ahead and at the next 3 months, 6 months, 1 year, 3 years. And I think over a sort of 12-month period, without a doubt, from the bottom, in all cases, you've seen double-digit returns. Now, I'm not going to say that that's exactly what we're going to see here, but we've already seen, I had a conversation with a number of clients when the markets had taken such a steep drop, and obviously no one could have predicted, oh, this is the time to come out, just before the coronavirus fears. But obviously there were a lot of people thinking, well, maybe, we should be coming out of the market, and that would have been the disastrous thing to do, because obviously you did that at 5.2 or whatever the level was of the FTSE. I'm talking about FTSE here. We're now over 6,000, and you have missed out on all of that bounce back. Now, who's to say that there's not going to be further downward spirals once the economic figures start coming out? But the key is that you don't buy a business into a business for a day or a week or a month. If you were buying a business, a trading business yourself, you are going to be buying it for a long term, whether that be a farm or be a manufacturing business. If you put yourself as the owner of that business, you're not going to just sort of buy in one day and sell the next. And that's not what our clients should be doing. They want to be buying good businesses. And this is where the managers that we're working with are looking at these businesses, and they're looking at the long-term prospects of these businesses. So I think that's about all I've got to say on that slide. Be interesting to see it in another 5 or 10 years' time, perhaps.
Yeah, absolutely. I think you're right. I think the key thing you touched upon there, Paul, is that there's no real predicting. Well, and this is probably shows it more than ever before, that to predict what would have happened at the start of the year would be nigh on impossible. The first case I think was reported New Year's Eve. That was after everyone had been publishing their 2020 outlooks and looking at things, and nobody would have foreseen this. So the timing, to get the timing spot on is pretty much impossible. What we can do is have a plan how to make the most of what we know, and guiding our clients along the way. But thanks, Sean. It's quite a simple slide, but such an effective slide to talk through, and there's so much information there in a pretty straightforward fashion of showing it. So it's again a great slide.
Yeah.
So those were our favourite slides from webinars we've been doing this week. Some things we wanted to highlight there. Integritas Wealth, that's who we are. We're an authorised and regulated investment business in Jersey. We're also appointed advisor of St James Place International and St James Place Investment Administration in Jersey, which is why you'll have seen some of the St James Place slides in there. We are authorised to advise on their products and investments. Before we leave you, we want to be able to do more of these, so please do send us any questions, send us anything you'd like us to cover in future video casts. But I would just like to point to a few things that we have been doing in the meantime. I'll point you to our website, so the homepage, integritaswealth.je, and we've added a COVID resources page, which I think is just a few useful tools that might come in handy right now in this period we're in with lockdown restrictions. Some handy resources: finances, education, health and well-being, and remote working, and a couple of useful resources that we provided ourselves. My Documents, which helps you get your financial affairs in order, and also we're offering a free financial health check. We think right now, while in lockdown, great time to take that time to review and have a look, have a review. We don't approve of knee-jerk reactions, but it's certainly a good time to assess your personal finances. So from there, I'll leave you, and we'll leave you. Thank you for listening. If you have listened all the way to the end, well done. And we'll try to do these frequently as we move forward. Thank you very much, and goodbye from us.